Hello, how are you? All's good there?
Good. All's good.
All right. So are you ready for our webinar?
Yeah, absolutely.
All right, great. So I think we can start right away because, yeah, it happened to be exactly 2 p.m. in Singapore. All right, okay. Hello, everyone. Good day and welcome to the E27 webinar. It's been a while since I last moderated our webinar series, so it's very good to see you all again. Hello, my name is Anissa from the E27 content team. So before we begin, I'd like to explain a little bit about what we're doing here. So we started the E27 webinar series to facilitate learning and development of the startup community in Southeast Asia. Every 2 weeks, we bring in expert speakers from the region to share their experiences and best practices on contemporary challenges. Kindly note that this session is recorded and we will be sharing the video post on our website later today. So today, the big topic for today is about exits, the myths and the reality. To help us unveil the fact behind the fiction, we have our special guest today, Mr. Dave Ng of Altara Ventures. Hello, Dave.
Hi, everyone.
Hi, Dave. How are you?
Good. I'm doing well.
Okay, awesome. So maybe you can tell us a little bit about yourself and Altara Ventures before we begin with our fireside chat.
Sure. I am like most people here, born and raised in this region in Southeast Asia. More than 20 over years ago, so I'm born and raised here. More than 20 over years ago, I went over to the US to pursue my undergraduate and graduate education. I did computer engineering at Carnegie Mellon University. And after that, actually started my career in the San Francisco Bay Area. Just spending a lot of time in the West Coast of the US. Started my career as a software engineer at Oracle back in the days. And subsequently, over the years, built several products for them, from things at the lower, what we call the lower stack of technology, right? Basically products like database and servers, and all the way to the upper stack, which is application software. Obviously back then, the term cloud computing wasn't popularized yet, right? So we just call it business software to a rather modest and humble term, right? Nothing fancy. Over the journey of my career, I have also worked as a management consultant at the Boston Consulting Group. During those period of time, I was actually based out of Southeast Asia. I was doing project work in Singapore, in Malaysia, and also in China. And after my career as a consultant, I was actually at a startup called Zuora. So Zuora is an enterprise SaaS company that does subscription business management software. So any business, if you have a subscription business model, for example, you've got Netflix, right? You're billing your customer on a monthly basis, recurring basis. Chances are, a lot of the business will be using Zuora today, especially at the enterprise side. So I joined Zuora when the company has less than 50 employees in the US office. And over the years, helped them to scale and expand from a single office in the US to multiple US offices. Eventually, we built footprint in Europe. Started with France and Germany and UK. And then we also expanded to Asia Pac, first through Sydney, and then eventually Singapore, and then subsequently Japan. And I left right before the company went IPO. We actually went back to Oracle to do my second tour of duty, but this time around, in the strategy function. So I was working very closely with the gentleman who lead the entire global business for Oracle in the cloud space. And that was right before I joined B Capital Group, which is a global venture fund that has presence in the US and Asia as well. So I was really early employee at B Capital Group, and started in their US office, and very soon moved back to Singapore and helped to launch their Asia office over here. And over the years, have the opportunity to back several entrepreneurs in this region, and also really be active in this part, being back home and being active again. And after B Capital, I was heading up Altara Ventures for Southeast Asia. And then that is just right before my partners and myself, we come together to launch Altara Ventures. So Altara Ventures focus on early stage investment in this region. We typically look at Series A tech companies. We will also look at cross-border opportunities. Whether if there are entrepreneurs who are looking to build for Southeast Asia and US, or Southeast Asia cross-border with India, China. I think we're very excited about those kind of business model as well. And maybe I'll just talk a little bit on my fellow partners here. All these gentlemen are also active participants of the ecosystem here in Southeast Asia for a long time already, right? Some of you might know Boon Hui, on the left hand side. He is industry veteran and renowned business leader over here and globally. And then Chow Boon and Kiat Wang, they were actually early employees of HP back in the days. This is 20 over 30 years ago, when HP itself, Hewlett Packard itself, was a startup in this region, right? So my partners, Chow Boon, Kiat Wang, and Boon Hui, they were actually at HP. Boon Hui was the managing director at HP back then, and Chow Boon and Kiat Wang was the young engineer starting out their career at HP. Subsequently, the three of them went on and found Omni Electronics together. Those were in the 90s. They spent the next 10 years building the companies until the early 2000s, brought the company to public, and eventually sold the company to Celestica. So for some of you who might not be familiar with what Omni Electronics does, they think of it as the Foxconn of Southeast Asia, or Flextronics of Southeast Asia, right? So this is during those time where Singapore, Malaysia are very active in the hardware space. Obviously before industry shifts and things increasingly shift to China and Vietnam, right? But those were the period of time where a lot of those activities were happening in this part of the world. And these gentlemen are the one that built a company and eventually exited them for $1 billion when they sold it to Celestica. The other partner, Gavin Teo, probably also just a quick introduction on him. He comes very deeply in the consumer and healthcare space. So he has led many investments in those sectors over the last 10 years or more. And very similar background, like most of us here. We are all native Southeast Asian. Gavin and myself, we also spent a lot of time in the US. Gavin and I overlapped for several years at B Capital Group, and prior to that, he was at Comcast Ventures in the US. So some of the companies that he has invested, for example, Twitch, that the gaming streaming platform that got acquired by Amazon. And of course, many healthcare companies and on the consumer space as well. So very excited today, and would love to discuss on the topic that we have.
Great, thank you very much for the introduction, Dave. Okay, so let's start with our first question. When one is starting a startup, a company, should they even do it with exit in mind, like building a company for the sake of exiting it one day in the end?
Yeah, I think that I would say if you were to do that, right, and take that approach, I would say that would be rather artificial, right? I think a lot of founders and entrepreneurs who started company and who found company have several objectives in mind, right? Obviously, commercial economics objective, they are going to be part of it, right? I mean, it's just the nature of the business. But many times there is also a greater vision and a greater objective and passion in mind. There's certain things that you believe that you're trying to solve for. There's certain things that you want to pursue on. That's why, and maybe you couldn't do it in your previous environment or existing environment, or you don't see it in the market. And you believe in the idea so much that that's why you decided to come out and do it. And very often, I would say Founders and entrepreneurs, some of the best one, always have it in mind in terms of, what they are really trying to build and trying to solve for. And the eventual, or at some point in the life cycle of the company, if an exit, call it quote unquote, right, an exit event happen, that is just more of a consequence or byproduct of things, right? But of course, very often, and I would say upfront in the sense that, when you are starting up your business upfront in the very early days, that topic or conversation is a little far out, right? So, chances are, one, you might not have a very concrete idea on how that scenario might look like, and two, whether it's your investors or your angels or your family and friends, likely they themselves also don't have a clear picture of, how that might look like, right? So it might be a bit premature, right, at the very early days to kind of talk about a topic or even think about a topic. But I would say, when a company gets to a certain pace and a certain stage, for example, if you have raised a couple of rounds of funding and, your business is starting to scale, some of this question will naturally come up for various reasons. It could be, maybe somebody in the team has a change in plan, or some of the goals and some of the thinking might have shifted, and therefore maybe not the whole team, but maybe one of the early member of the team have some sort of this kind of thought in mind, right? Sometimes it could be a conversation between existing founders. Sometimes it could be a conversation with new potential investors as well, right? Especially for investors that come in at a later stage, whether in the mid stage or later stage, this kind of question will naturally come up as discussion. I would say that by then, it is worthwhile to put some thoughts into scenarios, right? I wouldn't say that when founders and entrepreneurs build company, they try to build it to exit the company, right? Then it is really a purely a commercial pursuit versus a combination of passion, vision plus commercial pursuit, right? But at some point in time, people will think about it, and it is good to kind of have run through or thought through a few scenarios and kind of think through, what might some of this look like, right? To have a meaningful conversation with some of the at a later point in the life cycle of a company.
Okay, I see. So how does a founder tell when their company is actually ready for this exit?
Many times it will boils down to, what is the driver, right? And what might be the driver or motivation to have this kind of conversation. Natural path of, progress of company. And sometimes, maybe just to take a step back, right? The term exit, I would say it is, I would classify that as a more commercial term, right? Because many times, even when company goes public, if you talk to many of the experienced founder, they don't view that necessarily as an exit, right? My former colleague and boss at Zuora, for example, right? I remember back in the days when we were building and scaling up the company, and at some point there was always this goal and vision of bringing it to the public market, right? Going onto the NYSE. And I remember my former CEO, Tin Zuo, he will always say that think of IPO as not an exit, right? Think of it as the beginning, really the beginning of the life of a company where things really get exciting, right? And many times, for really visionary founders, they will look at going public or even getting a quote unquote a large capital infusion from a strategic partner. You can call it, you can call it an M&A or otherwise, right? But many visionary founders think of those events actually as getting into the next phase and the next stage of your company. You are actually raising more capital when you go to public market, right? Less so of looking at as a way to exit, as a way to get out of the business. You are actually trying to bring the business to a different milestone and at a different stage. And now that you have raised more capital from the public and being a public company, there are a set of things that you need to have in place, and you need to start being accountable for as you continue to build the company in their journey, right? The classical case in point is another example is look at Salesforce.com, right? When they went public in the early 2000s, they were a $2 billion company, right? Now, for many entrepreneurs, they might have called it that as an exit. But for Mark Benioff, that is really just the beginning. Because if you look at where Salesforce is today, they are a $200 over billion company, right? So they have grown 100 times, right, ever since going public. So I think it's very important to put that in mind, right? Whether you want to call it as an exit or you really want to call it as the beginning of the next phase of the next part of the journey, right? It's very important to decide, what you want out of it.
Okay, I see. So there are many ways to actually look at an IPOs. You can see it as either the end of the journey or the beginning of the journey itself.
It will be really tied to the vision of the team, the vision of the founders. Sometimes founders may have taken a back seat and passed on the torch to another team that continues to build the business, and it has happened. For the case of Cooper, for example, right? Another large leading cloud procurement SaaS company now in the US. And it was built by my ex roommate when I was in the US, fellow Indonesian, by the way, who was one of the founding architect of Cooper. The original team took the company to a certain point. At some point, they brought in a new CEO to come in, who has a different skill set, complementary set of experience to the co-founders. The CEO, and he's still the current CEO, by the way, Rob Bernstein. He brought the company all the way to IPO, and now Coupa is at a totally different stage as well as a company, right? I mean, when they went public, they were a $1 billion company, and today they are at 20 over billion, right? So it really depends on how you want to look at the life cycle of your vision and your company. I'm assuming many of the audience here are founders, are entrepreneurs, right? You're building things now. You might not know, what's the horizon, what's the timeline, but I would encourage and urge everyone, right, to try to think beyond what you typically see so far in Southeast Asia, because inherently, I believe, right, we are still in the very early days in Southeast Asia as an ecosystem. There's still a lot of things that's gonna look very different 5 years from now, 10 years from now, right? So as everyone build their businesses, right, think not just kind of like a start and stop kind of picture, right? But think beyond that, right? Think beyond that. How would Southeast Asia look like 5 years from now and 10 years from now, right? By then, would an exit, quote unquote, at that point still look like an exit today, right? Or by then, the environment would be totally different, right? Where you will get to a point where actually going public or merging with another strategic platform is actually the beginning of the next phase of your journey, right? So it's always two sides or several sides of the coin here. So
okay, thank you. So now let's talk about the exit strategy itself. So how can one choose the best strategy for their company? Like, do you have any tips on that?
So I think everybody will think about this topic differently, right? In the sense that just given that everybody will have different underlying thoughts and motivation behind it, right? But I would say if anyone or any company ever gets to that point, whether you are considering either going to public or merging with somebody or being acquired by somebody, right, quote unquote, in that kind of exit scenario, right? I think one of the few key things that is important to really understand is what is next, right? What is next after such an activity, and also especially when in the case of a strategic merger or acquisition, right? Who are your partners, right? Who is going to come in and work with you? That is very important. Or if it is a scenario where you are completely selling off your business, then what are some of the considerations? What are some of the things that you should have prior to taking that decision? for your existing team, right? For your fellow, employees, team members, and your fellow partners, right? And I think these are key considerations that everybody should think through. Of course, economics. There is always, economics, financial consideration, right? That is going to be part and parcel of, this kind of activity, and I would say those are more mechanical, right? It's more of a kind of a due diligence process that you go through. And I would say the more important one is actually on the strategic side of things, right? What happens after an IPO? What happens when an M&A happen, right? And who are you going to be partnering with? Will this work out? Especially in the case of a strategic coming together kind of thing, right? These are very important things.
Okay, I see. So I imagine one of the things that we also need to consider is that the trends and the situation of the year when the exit is set to happen. So in a year like this year, where so many things have happened and it's been quite challenging for the startup ecosystem, which one is actually the more ideal path? Is it like the right time for companies to actually jump into their exit now, or should they wait? And if they have to do it now, then which one is more ideal? Is it an IPO or an M&A? What do you think?
Yeah, the timing always makes a big difference. And there is never a hard and fast answer to this, right? There isn't a yes or no, right or wrong kind of thing. And I will give a few examples, right? Of course, this year has been I would say a rather interesting time, right? Just given how 2020 has panned out, and it is very funny because recently I was just being part of a discussion at another forum, and I was just telling everyone that if we were to kind of rewind back and go back to the end of 2019 and look at all those prediction article on how 2020 will look like, right? Everybody was predicting very, 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 very different but bullish things, right? Even some of the well-known fortune master from Hong Kong was saying that 2020 is going to be a great year, right? But of course, the next thing we know is where we're at now, right, today.
Yeah.
So just like that, right? In terms of timing, in terms of this year, right, or in a downturn, right, what might be the best scenario or approach always depends on the business itself, always depends on what the founders and the team and the business have, right? The various options that they could choose from. Now, if you look at 2020, with all these macro factors that's happening, right? We have a global healthcare pandemic that's gone ongoing, right? We have trade friction between two of the largest economies in the world, and we have all these various moving parts. But when you look at what's happening now in the U.S. market, especially in the tech market, right? It is actually it would have been rather counterintuitive, right, back then when COVID first happened, to say that this is the great time to go IPO, right? And when you look at it, in fact, a lot of companies decide to go IPO now, especially in the U.S. market, and that is because of several reasons, right? One is, once everybody see the fact that the general sentiment and fear has kind of stabilized, right? A lot of the activities are continuing, and many of the companies who have been planning to go IPO, going public, those are the considerations that has taken place a while back, right? So a lot of preparation has gone in place, and of course, right, I would say the other unexpected or less predicted byproduct of it is the amount of liquidity you have in the public equities market, right? When just given that there's so much of a quote unquote government stimulus and support, right? Liquidity being thrown into the market. That kind of provide a, I'll call it unprecedented time, right, for companies to go public, and because of the liquidity, a lot of people are kind of taking the opportunity now, right? Now, how this will sustain or how this will pan out, it is everybody's guess. But this is just an example of downturn could sometimes produce a certain dynamics might seems counterintuitive at first, right? But we have seen a good fair share of IPO activity this year. Same for M&A, same for merger and acquisitions, right? Because I think by the end of the day, it boils down to the fundamental of the business. Are you basically, are you trying to, are you the one that's being chased after, right? Meaning that the seller is coming to you and, sorry, the buyers are coming to you and ask you to sell, or you are the one that, that has a challenging situation and therefore you need to quickly find some sort of a arrangement, right? That makes, exit scenarios, it will make exit scenario look very different.
Okay, I see. All right, so I noticed that we have at least 3 questions in our Q&A box. So I think we can just start having a look at these questions. So the first one, we have a question from Serwa O. It's quite similar to the topic that we just discussed, but I think it's more on the perspective of the trend. So the question is, what is the impact of COVID-19 to investment scene and exits in this region? Are you seeing investment and exit to ramp up again, or investors and potential acquirers are still cautious? So what's the trend is like, in your opinion?
Yeah, so when COVID first happened, a lot of stakeholders, right, including basically both investors and founders, and other players of the ecosystem, everybody were rather cautious, I would say, in the sense that just because we don't know how the whole situation will pan out, right? I think, but very quickly, 3-4 months into it, at least, for many folks in the investor community, right, we have all gotten a pretty good sense on, or rather pretty good comfort and confidence on how things are shaping out in each of the different market. Of course, different countries, different market are responding differently. And therefore, I would say at the first few months, things do slow down, right? Things do slow down a little bit, right? Just given that there is a lot of internal thought process and conversation to kind of decide on, what would be next and what would be the things to focus on. By now, I would say, when I look across my peer, I would say activities are pretty much normalized, right? As in, a lot of conversations are ongoing with founders. A lot of the investments activities are taking place. Things might take, in certain circumstances, might take a little longer or more time than before, just given that, some of the traditional activities where, you want to be able to have more of a face-to-face conversation, it couldn't take place. So there might require more interactions, more, communications and back and forth interactions to get things done. I do see those continue to happen, right? So I would say by now, things have pretty found a new normal for itself.
Okay, thank you. Now we're moving on to the next question from Sanjay Patel. In an M&A situation for a SaaS platform, what is the reasonable time for the key development team or personnel to be locked in or tied into the company you have been acquired by? So this is more on the...
Yeah, so this could really varies, but what I've seen pretty often is a 2-year timeline. So many times, and whether it's in Asia or US, for example, when a team or a company got acquired or acqui-hired, right, however you want to call it, depending on what scenario, or even and then of course if the M&A involve a company at a later stage, larger stage, and the merger involve a larger amount, then the transaction might be a bit more complicated and there might be more structure to that. But I would say, if it is a earlier kind of acquisition or merger, typically, in the case of acquisition, it will be like a 2-year timeline, two-year kind of locked in, right? Where, of course, you have a bunch of most of the time there is business KPIs, right? Business indicators and things like that both sides will agree on and worked on, and agree to achieve together over those 2 years timeline, and that's what I've seen, from time to time.
Okay, I see. Okay, and now we're moving on to the next question. This one is from Sainul Abudin. Yeah, I know this guy. So the question is, if a company has multiple exit in terms of exits, how will it choose the best partner for the exit? What factors other than deal size that they should consider before grabbing the deal?
Yeah, I know this is a great question, and this is actually very similar to fundraising, right? Not just an exit. So when founders or entrepreneurs are raising funding and considering multiple term sheets, for example, or multiple offers from investors, I would say if you are in this situation, first of all, congratulate yourself and your team, right? To be able to pick and choose. I think the consideration is always several factors. Financial terms is one of it, but it shouldn't be the only factor. In fact, many times, in my whether it's at Altara or it's at my previous funds, we always tell our portfolio founders, right, our fellow partners over there, and basically tell them that financial is not everything, right? You have to look at the whole thing, the whole option on the table holistically, and many times is you want to if when you comes down to choosing a partner, you want to really make sure that these are the guys or these are the fellow who will have long-term alignment with you. They will essentially could see eye to eye with you in many different areas, whether it is on the business side of things or on the culture side of things or on the operating side of things, right? So that is very important, being truly aligned in the direction. And also there is also a little bit of style, right? Whether especially when you're choosing a partner, you need to be able to work with the partner on an ongoing basis. So understanding the style, understanding the character is very important. Besides just structuring the deal structure, what is being offered on the table. And then beyond that, on the business side, obviously being able to see value add from a potential partner is very important, right? And value adding is always something that a company should consider when you are getting into a merger situation.
All right. Okay. Thank you. So basically, it's not really that different with the fundraising, right?
I would say there's a lot of similarity.
Okay, I see. Right. So thank you, Sainul, for the question. And now we have another question from Mahendran Kanyapa. Okay, so there's a situation here. Let's just say a founder started a company with funding from angel investors. And then the company has grown to a level when they are starting to attract attention from VC to invest in them. At the same time, the angel investors want to recover their investment. So it's an exit for the angel investors. What's the option that the founder have to address this kind of situation?
Yeah, this is pretty common in the sense that common in the sense that in the grand scheme of so many companies out there, right? This is bound to happen, and many times it also depends a little bit on what are some of the terms or agreement or at least understanding and expectation, right? Just given that many times angels are more informal, or some of them they might have a more formalized agreement with you. But I would say if it's a situation where these angels are your friends and family, right? They have invested in you, put a faith in you, but just with based on expectation and understanding. it is then about, how you manage those expectation and relationship, right? Because there are a couple of sides to this kind of scenario typically, right? One is, sure, many angels are there to support companies in the very early days, and then give it years later, right? Several fundraise later, they might want to exit out of the company. And maybe go and do something else with their resources and things like that. So it boils down to one is, could you then have a conversation with new investors who are coming in, right? And assess whether there's an interest for them to also blend their investment with some sort of a secondary purchase of stake of these angels, right? And then, but I think the flip side of it that's very important to consider is what kind of signaling and what kind of positioning that might send to the new investors, right? Because you also want to balance it and not necessarily create the impression that for whatever reason there are some of your investors that are no longer backing you, right? Or might have lost their trust on you and things like that, right? So it's secondary purchase transaction, right, as part of a fundraise or part of future kind of financing activity is always a delicate thing, and should be definitely carefully managed. But if you manage it well, meaning that if you have the expectation managed right with your angels, essentially helping them to find a good time to potentially exit out of the business. And also, if you manage the other side well, meaning, with new investor who comes in and continue to be able to have the comfort and confidence, I think, this we see this pretty often, right? We see this happening all the time in companies that has grown to a certain stage.
Okay, I see. Now we're moving on to the next questions. This one is from Alexander Small. How can a startup align itself with acquirers to increase the likelihood of eventually getting acquired?
So this would be the case, let's say, if you have certain products or solutions or offerings, right, that could be very strategic to certain industry players or within certain sectors or industries. Typically, maybe there might be some sort of those kind of dynamic that exists. Then, when you either build your products or build your business, that is when you could explore. And this is assuming that this is one of the potential route that you want to, the team and the business wants to take, right? Then you could start off with some sort of a strategic business partnership, right? Whether you co-develop projects together or you develop products in collaboration with a strategic alongside, and over time, right, build that kind of relationship, that kind of cadence, that kind of ties, and at some point, assuming that the product, the solution for the particular segment takes off, right, it will naturally demonstrate value and demonstrate a fit into so-called, these potential acquirers, right? So a lot of, some of the businesses started that way, right? Especially if that's the route that the business and the team believe is going to be for the company. Then it is about getting yourself early on to collaborate with some of these acquirers, potential acquirers, and working in that direction.
Okay, I see. Thank you. Now we have another question, and I think it will be the last question that we're going to answer for this, because after this I still have other questions, and then we have to also prepare for the next session as well. All right, so this question is from Anonymous. Hi, hello, whoever you are. The question is, do you often see participating liquidation preference here in Southeast Asia? And if there is, what is the range of participation? And if a cap is commonplace to provide for VC's exit? Yes, so this is quite detailed question.
Yeah, well, a couple of things here. In the US, participating lit pref is rather uncommon, right? So I think just given the nature of the market, where it is, right, how mature it is, and also typically, you know, at the early stage, it tends to be more on leaning on the founder friendly side. So I would say by now, participating is rather aggressive if we're talking about a US market. Southeast Asia, interestingly, is a little bit of a mixed bag, right? Just given that, you know, in our region, our role has always been kind of the international exchange and melting pot, right? So you have folks who comes from the US, you have folks who comes from Europe, you have folks who come from China, India, Australia, you know, all over places, all of us hanging out here in Southeast Asia. And therefore it's a little bit of mixed bag, right? So I have seen a range of things. I have seen obviously term sheets that is more like a US, you know, traditional, typical US VC style. I've also seen term sheets that I would say, you know, maybe quote unquote, with an Asian flavor, right? So you tend to see a variety of that. And I would say typically, if I were to put myself, right, in the founder's shoe, in the entrepreneur's shoe, I would say, you know, try to, I would not encourage it, right? I would say, you know, not to have participating, right? But if typically there is, you know, if a potential investor wants to put in something that has participating, maybe there's something more fundamental beyond that, right? Just beyond this, you know, participating liquidation preference technicality, right? Maybe there's something in the structure of that potential investment needs to be revisited and needs to be talked about. Maybe there are different ways of doing things. Because to be fair, right, to some of the investors out there that might use, you know, take such an approach, it could be because there are certain points that they're trying to address. You know, most of the time, you know, when whether it's at term sheet stage or whether it's as part of the investment structure, when things are being structured in a certain way, it is because, you know, there are a few underlying points that investors are trying to address. And very often, you know, such points can be addressed in a variety of ways. Now, as a founder, as an entrepreneur, right, I will always encourage, you know, all the folks out there to really get down to, you know, what are some of these key points, and have that conversation, you know, with potential investors. I mean, assuming that this is a fundraise scenario, and see whether, you know, things could be structured in a different way, and structured in a way that you prefer, right? So otherwise, you know, if you don't take the initiative, if you kind of, you know, miss that out, then, you know, very often different firms, they might just have different templates or different standard terms that they use as a starting point, right? So I think it's always worthwhile to kind of really go beyond that and see actually what is the underlying point that is trying to be addressed with this kind of construct.
Okay, all right, thank you. So one last question from me. What are actually the factors that are preventing Southeast Asian startup from doing their IPO? Because if you look at the past history, it seems like IPO is still not a very popular option for startups in Southeast Asia compared to the other regions. So what are your thoughts on that?
Yeah, I would say there are a couple of areas that will continue to develop, and we will, you know, we will likely see more of these activities coming up in the future, right? And very often the, I would say in the common layman term, right, the so-called the IPOs that get attention is always the blockbuster ones, right? So for example, you know, recently Snowflake, which is the enterprise company that went IPO in the US, right? $80 billion valuation. A lot of people talk about the highly anticipated Ant Financial IPO, and now everybody's waiting to see when that's going to happen, right? So a lot of people always talk about blockbuster IPO, but truth of the matter is, there are a range of IPOs, right? There are IPOs, there are companies who decide to go public, also with, you know, less than 100 million market capitalization. or or a few hundred million market capitalization, right? So I think for Southeast Asia, one is there is a little bit of the maturity of the market, meaning that as an economy, as a market in various countries and across the various subsectors, we are continuing, we are emerging, right? We are classified as an emerging region, and that therefore it means we are continuing to grow, and there's a lot of bright indicators that shows that we are growing at a rapid pace in some of the areas, right? So there's a little bit of the maturity there for the whole macro to continue to deepen, and therefore as part of that, for startups, for tech companies that are innovating in those sectors, those segments, they will be able to have the opportunity to continue to ride with that, all these macro factors, right? So there's a little bit of that. And then of course the second one is also the business itself, right? To be able to go public, there are many things actually that needs to be gotten right? Besides the business traction and commercial side of things, there is actually a lot of preparation, readiness of the team, right? That is the most important, right? The management team needs to really be ready. That means you need to rethink a lot of your organization readiness, whether it's at the board level, all the way to maybe some of the more mundane stuff like compliances, committees, right? Processes. You need to have all this in place, and this on top of the other all the other paperwork, all the other behind the scene thing that happens in an IPO, right? So these are all the hard work that happens behind the scene that people don't often talk about, and people might not realize if you haven't really try to execute an IPO. And I think the business itself needs to get there, right? Many businesses here in the ecosystem, especially tech startups, tech companies, are still rather early on, right? And I think many will continue to get there, right, as things mature and evolve, and therefore, in the next 5 to 10 years, we'll definitely hope to see more activities in this side of things.
All right. Okay. Thank you. So I think we're starting to closing in on our time. So do you have any closing statement that you would like to say to the audience?
Well, I think one thing that is interesting to share, if you go back to a couple of slides back, one more, yeah. I think this is something that I would like to just take a minute to share, right? Because very often I hear a couple of things. One is, there aren't too many big exits in Southeast Asia, right? And two is, when should I build companies, especially given the context of COVID, right? When's the right time? Should I start my company now? Should I take certain strategic action? So this slide is, essentially what I want to share here is, if you look at historically, right? If you take a cut into the last couple of decades in the tech industry, interestingly, some of the best companies are actually built in tough times, right? And actually scale up in tough times, right? And this slide, has been arranged purposely in this manner, in the sense that if you look from top to bottom, right, that is all the various shocks that happen at the macro level, right? In the 70s and 80s, we have the oil shock, right? It's a global oil shock. Those were tough times, right? But guess who came up during those period of time, right? It's Microsoft, Apple, Oracle, and then on the right-hand side, Creative Technology, right? Fellow Southeast Asian company here that's flying the flag, right? I don't know how many folks here are old enough to remember Creative Technology, right? But if you don't, you should definitely read up the story over there, right? And then when we get to early 90s, right, it is again recession, right, during the period of time. And guess who came out during those period of time, right? Amazon, JobStreet, right, which is Southeast Asian, and Omni, which is also another Southeast Asian hardware company. That's my partners, some of my partners co-founded those company actually, as I mentioned early on. And then in late 90s, right, we all know the story here, right? This Asian financial crisis, and look at the folks who came up, right? Tencent, Alibaba, Google, and then in Malaysia you have Catcher Group, right? So again, there's a Southeast Asia kind of story there. And then in early 2000, right, this is the peak of the dot-com crash, and also SARS, right? What do we have here, right? YouTube, Facebook, LinkedIn, and Razer, right? Again, Razer is the Southeast Asian company here flying the flag, right? And now it's a public company, profitable, multi-billion-dollar valuation. And finally, in the late 2000, right? And you look at the folks here, we have WhatsApp, Airbnb, Uber, Xiaomi in China, and then Garena, C Group, right? So my point here is this, right? This year might be a very tough year, but actually, it's always two sides of the coin, right? It could be a tough year, but it's also a good time to build company, to really test out fundamentals, to really prove things out. Because if you can make things work in tough times, you can definitely make things work better in good times. And the right-hand side is just, as a form of, my counterpoint to a lot of the conversation, that I hear often that, there aren't, big tech story coming out of Southeast Asia. That's not true. So when we look at, in the past several decades, there is always something interesting that come out in Southeast Asia. And at each iteration, things are getting, bigger and bigger and more interesting. Especially if you look at where C Group is at today, right? $70 billion market cap company. I would say, that is, again, right, something unprecedented. And going forward in the next 5-10 years, I would hope to see, more stories coming out of this part of the world. And I would love to, speak to entrepreneurs who are passionate to build for Southeast Asia.
All right. Okay, Dave, that was a very inspiring session. Thank you very much for sharing your insights with us.
Thank you for your time.
Okay. And yes, for the audiences, I would like to remind you that we're going to send out a survey shortly after a webinar. So kindly take your time to let us know the topics that you wish to hear from us and how we can continue to improve this webinar. And meanwhile, you can always connect with us through our social media channels. And we also have a Telegram group for our community discussions. And yes, that is all for today. Thank you everyone for tuning in. And thank you very much, Dave, for sharing your time with us. So yeah, have a great day, everyone. Take care and stay safe.
Thank you. Bye-bye.
Bye-bye.